everyone. Hope you guys are having a great day as always. All right. So I'm super excited that in the very near term, we might be able to be doing these much more often because this will be more of a full-time / part-time thing for me. All right. So if you guys do not know, or you're not part of Capital Mindset Club, we have started a hedge fund. So that will be what we're focused on a go forward basis. And the disclosures, which I shall probably play an audio disclosure at the end of this live stream, but there's a fuller disclosure in the description below that I want to mention. So if you go there, there's a Google Doc that you can click and read through that. If not, I'll play like a little quirky AI generated, or at least vocally generated disclosure at the end, but I'll keep that towards the end. Just want to make sure that you guys know or are aware of its existence. Okay, so we got a lot of topics to go over. I have in the description, we have a, let's say, organized timetable of how we're going to go about this. Let me actually pull that up, have that on the side for me, so we're good on time. All right, so I will first begin talking a little bit of macro. I guess that's interesting, right? Stuff that matters, and you're going to base your entire investing opinion on, I guess. All the memes of like, honey, shut up, Jerome Powell's talking, right? Well, he spoke recently, and the commentary around that, of course, well, actually, we haven't had a live stream in a while, so there's been a lot that he said. But we've had rate cuts, right? We expected that. And there's been quite a few plays that was sort of a, buy the rumor, sell the news event. But more recently, what happened is the discussion around the ending of QT. And of course, more commentary on what rates are going to be looking like in the future. There's been discussions about, this is not the Fed themselves obviously saying this, but outside commentators discussing how politically in this environment, there's a lot of leeway for the Fed to maneuver and lower rates. There's that willingness to do so, obviously, from the current ruling party. And what we kind of see within the Fed is this sort of eagerness somewhat to actually finally stop quantitative tightening, which, if you guys didn't know, we've been in a quantitative tightening cycle since 2022. And in spite of that, the market has actually done really well. Some people think that the market cannot do well during a quantitative tightening cycle. But that's not necessarily the case. As all things are, it's nuanced, complicated, not so simple. The moment you think something is true, that's the moment it might not end up being true. A lot of things work in theory and not in practice, yada, 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 yada. So with that being said, all right, what are the implications of that? Well, there's quite a few. One of them could be some more flow of liquidity. I know you guys are like, well, isn't things really liquid? Look at what crypto is doing. Look at what gold's doing. Look at what these meme stocks are doing. These shitcos are doing. Yeah, all well and good. It looks like there could be more gas in the tank. But as you can kind of see, there's a lot of jitters. There's a lot of eagerness to panic. And so within Capital Mindset Club, there's like these I guess you could say almost joking moments about how efficient the market is when you get events like Friday, where a tweet could really quickly send the indices down red, and individual stocks down even more so, of course. And then what we saw, well, I don't need to remind you, Liberation Day and the whole fiasco where we were covering that. A lot of people are eager to panic, eager to make moves that are maybe too hasty or too, let's say, rash. And some people are coming to conclusions derived out of, their political linings, which, is interesting to observe. I know that the majority of money managers are politically unaligned with the current administration. And then that in and of itself creates a little bit more of maybe some opportunities where you see offsides behavior. What I mean by that is many fund managers might be ill-positioned for the market at hand, and then they're going to be forced buyers later on, et cetera. But offsides in both cases, you can be offsides, preceding a bear market, offsides preceding a bull market. So offsides is not, directionally biased in any sense. It just means bad, poorly positioned. So there's a lot out there that you guys have probably seen and said that's definitely a shitco. That's definitely not going to, make it over the long term. But hey, let me remind you that, this is not the first time, at least I've seen this. People older than me have seen this many more times than myself. And then if you're newer to the markets, well, hold on. Just wait and see. Just wait and see, because you'll see. And it feels a lot of times like how you might be missing out on a certain play or a certain theme, and it just doesn't make sense to you. But then you see it just like continue to run up every day, up 2-3%, and you get that FOMO, right? But trust me when I say that the majority of the people or the folks that are participating in things like that, well, that gut feeling you have might end up actually proving correctly, as long as you don't actually end up falling for it and being the last minute liquidity. Because of course, among those people, the best of them will be the ones who figure out, hey, it's time to take profits. And so they will live to tell the next tale. But what in that survivorship bias you don't see is all the people that didn't survive. And so that's what this game is all about. Investing is about longevity. It's about survivorship, right? So do you survive the 30-year compounding period, right? What we saw last Friday, to kind of continue on that same topic, we saw tons of anecdotals on social media of people doing terrible things to themselves because of frankly, a one-day move in crypto because of the leverage that people take on. And we are at elevated point of leverage. Retail is embracing leverage to a startling degree. It's very risk on. So that doesn't mean that we're going to get a crash. I see a lot of people calling for a crash, which makes me skeptical of it. Because there was going into the FOMC meeting recently, there was a setup for a healthy pullback, but as I don't know if some of the members in the audience who are in capital mindset can attest to this, but we kind of made the description or prescription that a lot of the bears would actually declare an early victory, but that we remained structurally bullish. And maybe a little bit too early to call, but I think we did see a little bit of a pullback, and we did see, and I called out specific contras actually to Dr. Latina. You know who those are, one of our members, and those specific contras almost to the day, because we had fun and we kind of tried to guess, and this was more of a fun gamble prediction about what day that contra or those contras would say what they said. And I think we were, either right on the money or maybe a day early on when they said or did the celebration. But that's more of a game that we play. Okay, so let me see where we are on the time. We're at the 12-minute mark, and I think I'm late. I am late. Private equity bubble. So moving on, private equity bubble. So a lot of people have also been calling, and this is sort of related to what we were just saying, this private equity bubble, this private credit, the next financial crisis. We have Steve Eisman bringing on people to his podcast. They're saying like, oh my gosh, private credit is this big problem that we have to worry about. And look at this company going bankrupt. It's bringing down all these companies like Jeffries, et cetera. Well, not bringing them down to their knees, but hurting them a little bit. And this call out, I would say, is a bit premature. And in fact, Andrew's in the chat here. We were having this conversation just the other day, and he was shout out to Andrew, because I think his timing on switching to constructively bullish on the private credit space for a few players, not like broadly speaking, but a few players, really came down to the contras being so loud that it almost like forced him to switch to bullish, because he was more neutral in our conversations where we were discussing in the background. And basically he was like, these I'm going to paraphrase. Well, actually, I'm going to make it more like PG. These regarded people on media, social media, are so regarded in their commentary on private credit, it makes me bullish. And I'm paraphrasing, but it was something along those lines. So the private credit Armageddon is the 2008 2.0, as we all know. And this couldn't be, I think, further from the truth, right? There is truth to it. Sorry, I shouldn't say there's no truth to it. There is some truth to it. There are some really bad actors out there, but not all players are created equal. And in the private credit space, you're going to have some really good players. And I'll call out a specific name. They're actually in the thumbnail, Apollo, which, for full disclosure, I am currently long, but as the disclosures go, at any point in time, that could change. But currently, I am long Apollo, and as of yesterday, pretty green on the position too. But with Apollo, they are considered among the best in the private credit space. Wow, couldn't say that word for a second. And their origination pipeline is unmatched. When we look at their pick as a percent of loans, it's also on the low side relative to its peer group. There's also onto the return side, they are typically under leveraged, because Apollo's sort of philosophy is that they allow the investor to take on the leverage. They don't take on the leverage at the fund level. Apollo also has Athene, which provides a tremendous amount of a permanent capital, which has been something that other private equity players have copied. So for you compound bros out there, especially those of you in Canada who love your Brookfield, Brookfield's copying Apollo. All right, Apollo is the one who led the charge, and then KKR also purchased Global Atlantic to also replicate that, because there are huge advantages to having this permanent capital. And again, you compound bros who love Brookfield, you know this already, because Bruce Flatt has said to you like why they're getting into insurance and the like. So I don't have to preach that to you guys, but it is a good move from all these players. Now, easier said than done, because who is the better insurer at the end of the day will speak volumes in the results. But Apollo as a private credit player is among the better ones. And then we can kind of go down or up the risk curve down in quality. And we look at Blue Owl. We can look at, some of the other ones that aren't publicly traded. And you start to see, okay, where does this narrative come from really? A lot of people point to Apollo as being problematic. But it's a lot of just like vibes, right? That's all they can really point to. And in fact, in the recent bankruptcy that's made headlines, where a lot of these credit players, and by the way, not all of them are non-banks. Some of them were banks that got involved, because there's this perception that the banks have this like magical underwriting, and that these private equity players, which by the way suck up among the best talent from the investment banking teams to them, right? So they're not filled with just like woohoos. They're filled with the top talent. They're somehow just like really bad, right? And the banks have magical sauce. That's not the case, right? That there's this, again, vibe perception that these private credit players, all of them are just terrible. That's just not true. So Apollo actually made money on this bankruptcy, and it's kind of funny to see like who got caught with their pants off, right? It's like that old saying, when the tide recedes, we'll see who's wearing shorts, right? Apollo is definitely wearing shorts in this case. And with Apollo, they have a lot of tailwinds ahead of them. This is turning from a private credit bubble, blah blah blah, to just like a bullish take on Apollo. But I'm trying to illustrate what Apollo has going for it, and why this bubble talk in the private credit space is kind of a nothing burger for at least these guys. But you have a lot of tailwinds going for them. They continue to raise tremendous amounts of capital and deploy said capital, because if you actually look at the dry powder, which oftentimes is used as a barometer of where earnings are going to be, Apollo is very efficient at deploying this capital, which is very important when you're looking at private equity. So if you actually look at the percentage of deployed capital or dry powder as a percentage of AUM, Apollo is going to be on the lower side of the large players. We're talking about the majors. And then Ares, I believe, is going to be the highest. Now, this can be viewed as a good thing or a bad thing. And in the bad sense, right, the negative Nancy way of looking at it is they're unable to act upon a pipeline, right? So this pipeline, there's not a lot of deals coming in. And because, okay, you could say sacrifice the quality. There must be sacrificing quality in order to deploy all that capital. That doesn't show up in the numbers, right? So that's one thing that, you should think about or consider there. Okay, so let me check on time. We're on the 18-minute mark, and I think I still have more time to go. Yes, we have 2 more minutes. So Let me see if there's any questions here on the topic, and if not, .com, young and stupid, BTC, young and stupid. Oh, you're saying for people participating in Bitcoin and the like. I want Andrew to explain how quantum continues to moon. Yeah, so that's what I'm saying. You could probably point to specific sectors that it's just like, what the heck is going on here? These guys don't even have any sales, and they're just a lot of rampant speculation. And absolutely, I'm just telling you, it won't end well. Now, will the quantum plays go bankrupt? That's out of the question now. If you see, they actually all, good for them. They took advantage of the situation, but they've all cleaned up their balance sheets. It's no longer a bankruptcy play. And so with shorts, you always have to be, very nimble about it. You don't want to let your ego sink in. So, with Martin Shkreli, who very popular on the platform, on X, etc., very smart guy too. He got really invested, almost like his personality behind this quantum short, and so that's where it can get very dangerous. Because that old adage is very true. Markets can stay rational longer than you can stay solvent, and so you just want to balance that out, right? He's right, but the timing is wrong, and in shorting, being wrong on timing is also still being wrong, right? So that's an important detail. Someone is deleting my comments. Are you sure? I can see all your comments. Let me come into the chat. I don't see like it's saying your comments are deleted. I don't know. Do you like Apollo at the current price? Yes, and I'll say that. I like Apollo at the current price. How many? I can see 1, 2, 3 comments from you. Because normally if it, there's a deleted comment, if a mod is deleting the comments, it will say, a comment was deleted. But that could be just YouTube preventing like what it believes is a spam or whatever. We gotta switch to live chat. Okay, so the next topic that we're going to be talking about is Equifax versus FICO. All right, so if you guys don't know, I've tweeted here and there positively about FICO, right? Because FICO is this like battleground stock where a lot of people look at it and say, crazy expensive, doesn't make any sense, et cetera, et cetera, et cetera. And so I like to talk about it because, it's a little bit controversial in that sense. And I was of the opinion that, FICO is deceptively expensive. Because there are plenty of scenarios that I'll remind everyone where FICO can prove to be not that expensive. So FICO has this stranglehold on the algorithmic side of creating your score, right? Your FICO score, and it's the lingua franca of finance. So typically, when you see a loan book portfolio of consumer loans, the question will be, what is the aggregate FICO score of said portfolio? And what I'm basically communicating to you is the creditworthiness on average of each of the borrowers, right? It's something we can both understand. And in that, there's this defensible moat that is very difficult to surmount. And then you have the credit bureaus, which are the providers of all the data. And so FICO provides that actual value add to the data and provides a score. Now, the 3 credit bureaus back in the day, they created a separate business, a third-party business. They all have a stake in, and that provides the Vantage score, which was meant to be a alternative option to FICO score. So FICO came under a lot of controversy, right, with Pulte basically saying, I'm going to lower the cost of purchasing a home. And he's kind of a silly person in the sense that he went after probably the lowest part of the cost, right, as far as percentage goes, and isn't going after the higher percentage of the cost, but focuses on FICO. And so the stock price has since been, sort of tumbling downward. Another thing about FICO is that, yes, undoubtedly, on a numbers basis, it was very expensive, and it fell roughly 50% up to the recent lows. Now, that being said, what does FICO's future look like? So the question on that really remains as far as how much price do they push to the consumer longer term? Because recently, what they were able to do was circumnavigate the credit bureaus in an offering for a continued relationship with the lenders. And this, in a way, was disguised a price increase because it was a price decrease by offering an alternative way to get the same product. But it was a disguised price increase because embedded in that is if you go directly with FICO, you can cut out the other players and just pay only FICO this lower price than before, but FICO gets more of a cut. So it's a disguised price increase. Now, if this ends up working out, excellent. Now, what did the credit bureaus do to fight back? Because basically, at this point, the credit bureaus, particularly Equifax, that I've seen, has been making a lot of aggressive changes that seem to be very combative towards FICO. Now, offering Vantage Score, or again, Vantage Score is owned by all three of them, but Equifax has also been offering your score for free and pushing or highlighting and advertising more and more of these other products because the other part of Equifax, the workforce business, is actually the cash cow and actually growth engine for Equifax. Really, the credit scoring business was more of the cash cow, slower growth business. So what they're effectively doing is they're taking their growth business, it's still doing well up and to the right, and then their cash cow business, they're being a bit more aggressive towards FICO. But really, this whole war started because and this is more speculation because I've been listening to the FICO CEO for a while now. There was some shenanigans afoot with Vantage Score acceptance by the regulators, but then FICO's newest model was taking a long time to be accepted, and it was suspiciously, of course, the FICO CEO, as political as he has to be, was, of course, like, oh, I have no idea what's going on, blah 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 blah. But it implied, or it sounded like a reasonable person could think that something else might have been happening behind the scenes because it didn't make sense why it was taking so long for their newest model to be accepted. And even though the newest FICO model was far away superior to the newest Vantage Score model, the newest Vantage Score model was better technically than the older FICO model. So that's a little bit of like, the start of the drama there. Okay. All right. But anyways, so that's basically the gist of it. And FICO is going to be in the future judged on how much price it can increase and then multiply that by the volume increase. So volume increase and price increase. And that's been the story for a while. And that's what I said on my tweets talking about FICO. And that's what I'm saying to you guys here today. That's all that matters. So if you can figure that out, you can get a gauge of what the forward earnings are actually going to be for FICO. And what I can tell you now is that FICO's volume is at a low point given where the industry's at. We don't have much lending growth in mortgages right now. The whole industry is at a standstill, right? We're at a multi-year low. Now, do we stay at this low? Do we have a recovery? That's, what's up in the air for questions and concerns and debate. So. All right. I see people are in the comments or talking about comments, right? About deleting and stuff. So I guess that will get sorted out among you guys. Yeah. All right. And so that's FICO. If you actually take that multiple aggregate of what volume could recover to, and you can see online various analysts have provided a matrix for how much do rates have to go down by and what spike in volume does that cause. I believe off the top of my head, it's like a quarter cut in mortgage rates, because let's get back to that in just a second. And mortgage rates could lead an estimated upwards of 20% increase in mortgage origination demand. So why do I say, well, what's this distinguishment between the long end of the curve and the short end of the curve? Well, that's because they are separated. And the short end of the curve, we just saw rates go down. Well, some people, let's say normal people, might think, oh, Rates went down. The Federal Reserve lowered rates. That must mean mortgage rates are going down. So I'm going to go buy a mortgage. I'm going to go check out what the mortgage rates are. And they didn't move. And you're like, what? This makes no sense. Well, yeah. For us, we should know that the short end of the curve and the long end of the curve, while one does have an impact on the other, depending on what other factors are at play, they're not correlated one for one. And so just because the short end of the curve is going down does not mean the long end of the curve comes down too. And that's what I meant earlier when I said that was a buy the rumor, sell the news for many of the mortgage related stocks. So if you actually see the mortgage originators and the like, a lot of them ran up into the rate cut announcement. And then once the rate cut announcement happened and you saw the digestion of that, you saw their share prices come down. And so, rocket companies, PFSI, etc., all of those, it was a buy the rumor, sell the news. And now could be a buy again. Who knows? All right, so we got some questions. Well, we are going to talk about PayPal. We're going to talk about PayPal in 5 minutes, but I'll answer these questions here. So PayPal or NMIH? So mortgage insurer or legacy fintech? Totally different place. But if you're, I would argue a clear, more like buy and hold type play. My opinion, if you're forcing me to say one or the other, I'll get back to you. No, I'd lean on NMIH. So PayPal, we'll talk about PayPal because for me, PayPal is not really that for me. We're about to discuss the whole argument because as you guys who followed Capital Mindset for a long time, you guys remember I was a PayPal bear when being a PayPal bear was not cool. Now being a PayPal bear is pretty cool. Now, being a PayPal bull, right? And bull with a big asterisk there on like a lot of details to follow, can be difficult when you have a lot of regarded people also bullish. But we'll talk about that because I think they've suffered enough. They've been clapped by a dead money stock for enough time. They get some reprieve, but only when I'm in it, so I can make money. But yeah, there was, I mean, going back as far as like 2022, 2021, PayPal. What do I think about Ferrari at this price? It's expensive. I think Ferrari, the arbitrage in the fair value to the market price was really when it IPO'd. That closed up so fast. Here, it's like a story everyone understands. I'm not particularly fond of it. I think there's other things that I understand better and feel will generate a higher rate of return. I view it as maybe like a trophy asset. I'd be like, oh, I own Ferrari, but I don't really care for that right now. So everyone knows the pricing power of Ferrari. It would have to come down quite a bit because it's trading in line with like a Hermes in terms of multiples go. And I'm kicking myself because I was on the cusp of buying that when it spun out, and that was a mistake because that genuinely there was a huge disconnect between the unit economics and the branding of what it was. Right, it was just another car company, and the multiple re-rate is where you got most of that return. So unfortunate. My average cost on PayPal. Well, I don't have PayPal shares, but the contracts, I'd have to log in. I know it's a little bit lower than what the contracts were a few days ago. So, or yesterday. Yeah, because Friday. Yeah, it's lower than what it was yesterday. So I'm green on the position. but I don't have shares on PayPal. Ferrari F1 is complete. Ass. All right, how are we on timing? So we are. I might start it early because people are asking a lot about PayPal and Meta or Amazon. This is an interesting question. So Meta, if you factor out the expenses on Reality Labs or the losses on Reality Labs, it's actually not that expensive. But that being said, I view Amazon as having clearer paths to success than Meta has on a go forward basis. It's more understandable to me. But never doubt Zuckerberg, I guess you could say. Oh, and yes, we can talk about Progressive super quick, but I will spend more time at the end of the stream, towards the end of the stream in the Q&A. But Progressive reported earnings today, their monthly earnings, and the reaction is very interesting. Down on what looks like to be numbers that they had to basically pay back money because they made too much money in Florida. So over the prior 3 years, they made too much money in Florida and they had to expense that all at once. And so the stock's down like 10% or so. And you get still an adjusted combined ratio after you remove that silly expense, right? What the actual business is doing, it's 86% combined ratio still, and still growing at in tough comps comparables, 13-ish, 14%. So still pretty good, right? And now it's trading even cheaper. So that's going to be interesting because that one is definitely out of favor. Again, in this environment that we're talking about, something like a Progressive is going to be out of favor. But, stuff starts to hit the fan. Yeah, things change. People go, oh my gosh, wait, this makes a lot of money. So we'll kind of see how that progresses. All right, let's get into PayPal. So I have something to talk about here. Let's share my screen. So I titled this section or this segment "Grave Dancing" because I see a lot of people grave dancing on it. Now, I don't know exactly what this person's stance was on PayPal a few years ago, but I say grave dancing because I like to point out and remind everyone that you are listening right now to one of the original PayPal bears, and I was bearish on PayPal when it was not really cool to be bearish on PayPal. Now, there are a lot of regarded people who are bullish PayPal. That is perhaps the one thing that I go, fuck, but my mind changes when the facts change. And so a lot of it's funny to see other people say it, but a lot of these points were things that I would have said years ago as well, right? But some of them here are not as valid as when you look under the hood. So let's talk about the opportunity set within PayPal. So PayPal's been, yes, dead money for years now. You look at it and it's like, what the fuck is this? Well, then, gonna say it. I told you so. But at the time it was, I guess very, very controversial. In fact, one of the YouTube grifters for some reason uses PayPal as like a barometer competition for me. Which is funny, if this grifter is listening. I'm also now along PayPal, so we're in this together, buddy. But anyways, okay. So Stripe is destroying PayPal as a payment processor for business, not even a competition. Well, I mean, sure. I mean, I don't know what to say really to that point because it's Stripe, Adyen, Braintree as far as like the three honchos go. But it's not something that you can really counter that point. It's just saying something. Who even uses PayPal anymore? It isn't 100 years old when there's Apple Pay, Google Pay, Revolt Pay in Europe, just a regular credit card. Yeah. So this was the argument for why the core business was not going to struggle to grow. Right. There's plenty of alternatives. and yada, yada, yada. Now, this comes from a lot of, you look at Google Pay, Apple Pay, and the like. And what's odd about that is people are citing figures that, just by themselves doesn't make a lot of uh, sense, right? What I mean by that. So Apple Pay is very popular, a lot of GPV, but a lot of what counts as Apple Pay is not the same thing as what would normally count as what you would use for PayPal. So they're almost like in two separate, realms. A lot of Apple Pay is, from the App Store. You interact with apps and then you transact in the apps. And that will count as an Apple Pay transaction, similarly with Google Pay. And then, of course, like when you're in a physical location, right, you're trying to use a physical credit card, some people will utilize Apple Pay. I don't perceive this as a necessary threat to what PayPal's core business offering is for what people utilize it for. And within the white label product space, that's Braintree, that's going to be more so where I'd focus most of my time and attention on that. Venmo, which a lot of the fintech individuals in our club have highlighted the absolute abysmal management of this asset. Because if you look at Cash App, which this person points out, one thing that you should note is there's a huge demographic difference between Cash App and Venmo. And depending on what demographic you belong to, one or the other will be the prevailing use or used one. And it is true, Venmo was neglected. And that was a criticism, but that was a criticism I had for the prior management. And when this management took over, I was watching them with interest, but you could have waited. You could have just simply waited for them to show you changes. In the last earnings call, in fact, it was kind of sad. I felt bad for him, but he was like, I'm paraphrasing. He's like, no one asked, but Venmo did really well because no one asked. No one cares. But no, Venmo is doing much better now. The monetization efforts at Venmo are paying off, but again, that's something no one really pays attention to. No one cares. Okay, so then revenue is flat when you adjust for. I always do this as well. I always adjust, revenue for M2 money expansion. If you're not doing this, I don't know what you're doing. Right? Am I right? So we all do that, right? In our analysis, you adjust for M2 money expansion. I do. And then if you look at earnings growth for PayPal, alongside some of the other comparable cheap stocks that retail likes to look at is pretty good. It's like 12% CAGR on a go forward basis. From what sell side has, and then if you kind of bounce around within that range, that's decent for the multiple you're paying. Revenue growth, it depends on how your revenue recognition is. So that's what retail sometimes fails to understand. It's like not all revenue is created equal. Not all businesses sales are created equal. It really does depend on like where the revenue is coming from and how you're recognizing the revenue. So you can have a business that has a very funky revenue recognition principle, but then your profits are growing in an exorbitant amount more than that percentage growth in revenue. So it really depends. Well, yes, in many cases it's a good barometer. It's not always like the best barometer, but yeah, I always adjust for M2 money expansion. It's a very important thing to do. Number 5, active accounts increased 2%. Lower quality accounts generating less revenue per user. Now, this was a bit of a concern previously, but it's funny because like when I was arguing against or this point to the bulls, it was they were growing user accounts and then they were declining user accounts, and then the bulls were arguing, hey, like they're keeping the better accounts, right? And as far as like a narrative goes, that's most like a coping narrative. Right now, the user account growth and being lower quality, again, kind of aside from the point, because I'm not paying too much attention to the core business as much as it's just this cash cow that I'm just watching out for deterioration. And if there is serious deterioration, then yeah, you got to adjust your thesis. Marketing expenses, okay, whatever on that. They offer BNPL, so does everyone. So this is a huge misunderstanding that everyone has about buy now, pay later. This person might also have some similar silly opinions about, the nuances of a firm, etc. Oh, buy now, pay never kind of people that think, they're very clever in saying that. But no, PayPal, the paying for that it has, a lot of what that is, just simply it's not like the same as what a firm is doing. A firm's is much more. This is probably bearish on PayPal, by the way. It's not necessarily a good thing, but a firm is much better at this than PayPal is. The firm's underwriting standards, or not underwriting standards, underwriting capabilities are showing to be superior to that of PayPal. But pay in four is not, anything, too crazy. That is more or less correct. But one thing that they have been doing, which when they did it, and I was still a PayPal bear, but they switched the strategy up a bit, is that they take these off balance sheet. So they sell them to some of these private credit players, KKR, Blue Owl, etc. So they're just facilitating the transactions and then taking like a small profit from it, but selling it off to someone else, which I think is positive. For me, a company like PayPal, I don't think they should be in the business of that. That's not their core focus. And then point number eight, PayPal for international transfers is basically useless. The fees are ridiculous. Yeah, in this stance, point number eight, actually decently valid as far as like the competitiveness goes. It is definitely race about. All right, so now is the thesis reliant on buybacks? Because the person brings that up, etc. I would say no. The thesis does not rely on buybacks, and I see like some of the bulls who've been in the stock for a long time have capitulated. I saw a funny one where someone sent me saying they need to switch to dividends, and I'm like, well, that's silly. If you think the stock is cheap, if you think the stock's expensive, absolutely switch to dividends. But the right now, right, it's all predicated on what's going to happen with the reacceleration of growth, right? If that happens, then you're off to the races here, because the market doesn't assume there's going to be any acceleration in growth. And the growth that's there, don't get me wrong, is okay. It's good. It's some of these other businesses that are cheap optically, there is no acceleration in growth coming for them. And so, and those are more like buyback stories, but they're poor ones at that. Because a real buyback story, I mean, there's other names I could say, but some of these popular retail stocks, they're not buyback stories yet. They're still relatively expensive. In fact, people are misquoting how cheap they are. But PayPal, in terms of a buyback story, it's not hinging on that, in my opinion. And if that's what you're relying on, you're invested completely for the wrong reasons, and you might be in for a shock. Because if the following doesn't happen, right? If the growth acceleration does not reoccur, you're in for a real pain pal. And when I say pain pal, probably like still dead money / underperformance for a while. But if reacceleration does occur, which I think we should see in the next quarter and then the following quarter, because they are lapping tough comps, then you could start to see this, a reappreciation in the price. And it's the most regarded, or some of the regarded folks, they've abandoned it, which is optimistic for me. But some of the regarded people stayed. And then there's the people who are the true believers that have actually a really constructive opinion on this, to be fair. So I don't want to paint it that everyone involved is like that. It's just, you guys know who I'm talking about when I say that. So really, if we see in the next quarter or the quarter after that, this reacceleration in growth, in particular the white label product, which has been the focal point of the management team for a while, and their guidance indicates that this is these following quarters will be when we start to see that. Then you play from there, right? If it's incorrect, right, that growth reacceleration doesn't occur, then I will say, then this thing is still dead in the water. You do not want to rely on a buyback thesis, especially in particular when the company's not that cheap for a buyback thesis to really play out like that. So this chat have not. Okay, let me go through. Good morning. It's been a year since caught a live stream. Are you getting yoked or fat? good day either way. I don't know. Demographic about Cash App is 100%. Yes. So yeah, it's completely different demographics. I don't use either, except I'm forced to use Venmo because some people in my circle use Venmo, and I say like, oh, I have to use this app because other people use it. But Cash App, nah, I don't know anyone who uses Cash App. But again, that comes down to demographics, region, etc. And then Cash App, as far as like you know, actual execution goes, has been excellent. Like they added a bunch of features along the, you can invest, you can do all these other things with Cash App, like a savings account. But Venmo's been adding some of these features, and I think they're going to continue to add new features such as investing, etc. So different things coming. But this management team's done a good job, I would say, because when he first joined, I was skeptical, and all the bulls were like, "Oh, this guy, he's the greatest guy. He walks on water," and and I was like, "Okay, you have plenty of time to see what happens." And I mean, how long has it been now? And the stock hasn't moved. Now, I'm involved though, so I am long PayPal now, but you had plenty of time to just sit back, watch him do his thing, see the execution, see if he says what he or does what he says, right? And then kind of go from there. And so now I think the best way to express that long view is, via, I'll say, at least for my full disclosure, I'm long via call options. And then the positioning of it is such that it's like a tactical long, so to speak. So I am bullish PayPal. It's not my largest position by any stretch, but I'm going to have fun if I end up making money on this name, given the fact that, again, I've spent most of my time here on YouTube being constructively negative. I don't think I was a negative Nancy on PayPal. I think if you look back, I was constructively negative on it. And I think that people, when they were evaluating PayPal, giving it like a $300 price target, hindsight's 2020, but they were silly. They were silly. All right. So if people in this chat have not joined the CM Discord, please do it now. Well, thank you for that shout out. And yeah, the link is in the description below. Okay. So I wanted to this one was sent to me. If you guys want me to talk any other details about PayPal, feel free. Yeah, this one was sent to me, so I thought I'd give it a reaction. That's my rebuttal for this person saying, feel free to have a rebuttal. I mean, I'm not going to tag this person. I can't be bothered to tag them, but yeah, that's my rebuttal to them. Yeah, so some points are correct. Other points are just statements that, it's like, okay, I can say that about really any of them. Adyen's killing the others. Stripe is killing all of them. Braintree is coming for their lunch. So because I'll add this point. So Braintree was actually harming Adyen for a while. How do I know this? Well, I also follow Adyen. And Adyen back in 2023 in their earnings calls, they didn't name them outright, I believe. I'm trying to remember, but I don't think they named Braintree. But they said one of our competitors is pushing on price, and that's stunting our growth, right? But we continue to believe that Adyen is a superior product because yada, 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 right? But the point is that Braintree was coming after a lot of Adyen's business. And it wasn't that Adyen was shrinking, far from it. Adyen was still growing, but Adyen wasn't growing as fast. And so the market punished Adyen, and the management had commentary around that. Braintree, under the prior management, was pushing for growth at all costs, which a lot of that has to do with why you saw the TPV come down. Or sorry, not TPV come down, take rate come down on the TPV. So because, of course, the white label product is going to be inherently, right, lower take rate than the branded checkout. And there's a lot of reasons as to why still the Braintree business is very, very, very attractive, such as like Adyen. Adyen is a very attractive business. Braintree, I'm telling you, it just like is funky on the recognition of certain statistics or key performance indicators, when you meld them together, it gets a little wonky and it confuses people. And I see that a lot. So a lot of people are getting confused because they're bunching it together versus, with other players, it's let's say cleaner. It's easier to understand because it's not all bunched up into, one thing, because not all TPV is created equal. It really does depend on where it comes from. But if PayPal didn't have and Braintree was a standalone, I think it would be a lot more clear to people. But Braintree is really attractive. Just because the take rate's coming down doesn't necessarily mean it's a bad thing, right? A lot of people misjudge it on that way. But on a go forward basis, if they're renegotiating those contracts, which again, that's why they had this like tough comps comparison for a while. And this is why the reacceleration was set to happen, this quarter, next quarter. It's because, well, it makes a lot of sense. If management comes in, says, okay, well, let's renegotiate some of these contracts. Let's focus on this strategy and change it up from, growth at all cost strategy. Well, what do you expect to happen? Do you expect growth to suddenly slow down and you have to lap a whole year almost before things start to look optimistic again? The same thing's happening with Evolution Gaming. In a sense, it's a self-inflicted damage to their growth, and the stock got punished for it, which makes it interesting, right? So no to both. What are you currently buying right now? Quite a few things. But all right, so let's see where we are on time. Okay, so still good on. Oh, actually, no, I'm late. Healthcare. Yeah, sorry, I was checking on the time. So healthcare. So healthcare was a pretty dramatic fall, so to speak. And I made a video on United Health stock. Yes, I get it. Controversial stock. But let's talk a little bit about this. So I'll give you guys the soft pitch, or not the soft pitch, the quick and dirty pitch. So healthcare came under fire for a variety of controversial reasons. People, talking smack about it. A lot of narratives spilled out that I thought were hilarious. Well, I will answer the super chat. By the way, like I said, I'm going to be full time doing this. I need to start e-begging. Right? You guys need a a strongman says, my pay pigs. I'll look at TAC. I'll honor the super chat. I often don't get super chats. People just say, oh, the rich can't get richer, so no money for you. So I need Chipotle bowls, guys. Please help me. Wink. Anyways, so United Health. United Health stock is again the poster boy for the space, and what I was the most excited to accumulate. But unfortunately, in the midst of my strong accumulation, I only got roughly like 100,000 into it, and the position decided to run. Right. So that was unfortunate, but I'm hopeful. Maybe something happens and pulls back again. But some of the problems that people cite. Oh, and I'll talk about the Steve Eisman podcast where he brought on a United Health analyst, or an analyst covering United Health, and I'll just say the short and dirty. That guy, respectfully, is kind of clueless. So he was hyper bullish at 600, turns bearish at the low, and then says things that make no sense. What are some of the things that discredited him in the interview? Well, major one that a lot of the healthcare investors in the club pointed out. He stated that United Health is the only one going through these unique challenges. Well, that made me go, "What? You're a healthcare analyst and you say that? Do you not listen to any of the other ones? What's going on here? Do you not listen to earnings calls?" Now, Don't get me wrong. United Health did some bad things. What are some bad things United Health did? Well, I jokingly say or use the analogy. You guys know the meme of like, I can fix her. Well, United Health did that with some markets. United Health pushed into markets that others were leaving, particularly CVS. So CVS had gone through this already, and CVS had done the remedies needed to fix the problem already. And CVS left certain markets. Well, United Health said, well, in an effort, this is the prior management, in an effort to grow revenue, right? We don't care about revenue growth, by the way. We care about profit growth. Revenue, I'm going to enter those markets. And it's like, okay, that guy, he failed, but I can fix her, right? So that funny meme, all right? That was United Health with certain markets, and that hurt them quite a bit. But the solution to that is simple, right? Your contracts lap, right? And then once those contracts lap, you pull out. You pull out of those policies. You remove those policies. You start cleaning your portfolio of offerings. And so that's really, I mean, these businesses are complicated, but the problem that they are going through isn't that complicated. Like, I want to respect the complexity of the business. I understand that for many people, they look at this and they're like, this is crazy, lots of moving parts, etc. But it's not actually that difficult. I know it sounds like a lot of time, but if I sat with you and spoke to you for 3 to 4 hours, right? I'm confident that by the end of it, you could probably say I kind of get what's going on here. And that's it. In capital mindset, like I would say in terms of the content time of speaking on healthcare while the whole fiasco is going down, I'd probably guesstimate that there's like between 20 and 30 hours of recorded conversations on on this. I think at one point one of the physicians in the server was like, every time I joined the voice, this was back when it was like crashing every day, right? And we were just having conversations about it. It's like every time I joined the voice, you guys are talking about United Healthcare. Because there is a lot. If you want to dig deep into it, there's a lot to cover. Absolutely. So like, I don't want to dismiss it, but after a while, it's not, the remedy isn't that difficult. And so a lot of the recovery, and people are saying, oh no, this is like a 7-year, 5-year, 3-year recovery. It's like, not really. And that's why the market has snapped back quite a bit, right? So a lot of investors, let's say the market itself came to its senses. Look at that. We're pumping the stock right now by talking about it. You see that move up there? That's the stream. We moved billions of dollars, right? Anyways, jokes aside. So the whole space, this analyst that went on Steve Eisman, we're coming back to that. He said, they're the only ones having these unique problems. So immediately I'm looking at that. I'm like, all right, well, this guy was bullish at 600, bearish at the lows, and then says something like that. What do I listen further? And then it got worse. I mean, it got to the point where he started saying, they didn't disclose it, but it was disclosed in the 10K. So saying certain things weren't disclosed, but they were disclosed in the 10K. And it's like, as is his job, he should be, obviously reading the 10K. And so I was very concerned that the individual did not know something was disclosed in the 10K. It was a sale and repurchase of an asset. But anyways, nonetheless, so we didn't have to go that far to already dismiss him. Already by him saying that it was a unique issue to United Health was dismissible on its face. Made no sense. And then so the other players like Elevance, which I also, full disclosure, have a long position, Molina, full disclosure, have a long position. The whole space got very, very interesting. And you had an opportunity for something that is both offensive and defensive. What I mean by that is, every so often you get this opportunity, let's say, I don't want to, give an exact cadence, but I'd estimate like maybe once a year, a sector sells off. And when you have a sector-wide sell-off, when you have a lot of fear, when you have a lot of bullshit being spewed everywhere by people who don't know what they're talking about, there's probably diamonds there. And you just have to, sit down, think about it, figure it out, pick it up, and collect these diamonds. But the offensive and defensive nature of healthcare is really the starting point of that idea is because of the sell-off. right? That allows them to be now offensive in the sense that you could see tremendous capital appreciation from the lows, right? At the same time, playing defensive, if the rest of the market does end up taking a shit, then you have a protection of capital. You have a lower volatility, uncorrelated asset from the rest of the market. And so those of you who did pick up healthcare and you're sitting on, I know that we have one member who went very heavy, very confident in UNH. And I think a very good price point. And so, like, if tomorrow the stock market were to throw over, right, itself, or the economy were to throw over their portfolio, I would be very jealous of their portfolio. I think most people would be very jealous of their portfolio. They would probably handle it pretty well. I actually have not gotten an update from them if they trimmed it, because they should be up quite a bit now. So maybe they've trimmed it back a bit, but it was well over half of their portfolio, for some context there. Oh, there he is. Okay, so, well, you ousted yourself. You said hi as soon as I mentioned you. So, you ousted yourself. I don't know if you trimmed it. But like I said to Juice in Capital Mindset, I was like, well, dude, if the market just like throws over, you're just going to be there just like, sell off. You guys are the AI bubble popped? What? That's crazy. I had no idea. Wouldn't know. Oh, I'll go ahead and just send you the invite link, Andrew. I'll post it up in the analysts room. So whenever you want to. He probably added knowing him. Yeah, VC was popping off on healthcare. Yeah. I mean, it was the opportunity of the time. I tend to find that when it gets annoying when we're talking about something, that tends to be when maybe it's the most exciting. Because I also remember the same thing occurred for other names, Meta, Netflix, etc. Like you get this like, there's so much focus on this. All right, look at that.
What's going on?
Look at that handsome man.
Actually, get to see me in my office for once.
Oh, yeah. You know what? I need to change up this decoration. This obvious brick wall that's real. I need to start.
It is real.
Oh, yeah, no, it is real. Everyone doubts it's real. This is a brick wall.
I'm currently. You currently talking about healthcare? Is that it?
Yeah.
Okay. I'm currently dealing with getting squeezed on a couple shorts and just looking at them and seeing why they're squeezing.
Which ones?
iRobot and I think QSI. QSI, I think it's just technicals, but that's fine. It's
iRobot.
So iRobot's, yeah, I think it's because it has robot in the name. I think that's why. I'm trying to look for it, but if you look at their balance sheet, these guys are, in my opinion, potentially going to be BK by end of the year. This to me feels like it's going to be Sonder. Do you know what Sonder's trading at right now?
Let me take a look at these guys. Sonder.
Yeah.
Oh, they changed their ticker?
No.
I guess I need to.
They're at 94 cents right now.
Oh my gosh!
Look at the chart.
Yeah,
dude, I was right. I mean, I was stupid to do what I did, but it was right.
Look at that fucking destruction.
Yeah. Anyways, I don't want to. I'm sure people don't want to hear me talk about how iRobot, how you look at their current debt and everything, how they're going to die. The debtors aren't even letting them pick out the interest. Like they're making them pay it. I'm pretty sure. Let me just double check on that. But
don't you love it when your debtors make you pay money? That's crazy.
See adjustments to net CAD.
I'm looking at the super chats request for TAC. I can see already why this thing has done so well. It's part of the AI data center energy theme.
Oh.
Yeah. So like it's being picked up with that. So but it's a Canadian business. They have presence in Alberta, British Columbia, and Ontario. And they have a lot of hydro, wind, solar, gas, about 900 and some odd megawatts of capacity in hydroelectric, and also has ownership interests in a few solar farms, battery storage facilities. So I mean, it's hitting the whole shebang. So what I'm getting with that for TAC, and let me show the audience the share price performance. I mean, since April especially, anything that's been involved in the energy side for data center has been killing it.
I mean, look at Generac today.
Oh man, well, we have to full disclosure if we talk about it. We're long Generac.
Sorry,
we have to do this. You know, it's very important. Well, we did it before. It's not like we didn't do it, but yeah, for full disclosure, we were long Generac. But yeah, so Generac's part of that. Wow, that's actually a nice move today. Andrew, why is the stock? Why is it going down? It's going down.
I think in the last 15 minutes, the market has agreed it's a bad stock.
Okay. It's bad stock.
Yeah.
Okay. Good. Needed to know that.
I'm just looking at TransAlta right now. What do they do? Battery energy storage.
Yeah.
Oh, okay. They have BESS. Okay.
No, they have everything in terms of like what narrative you're trying to strike. Battery storage, energy capacity, and
okay,
it's just in Canada. So I mean, this chart look at that. Like what narrative shift? Wow. Because from here to here, you know, there's a lot of other energy codes that also sold off, and then subsequent to that April sell-off, have just roared higher. And so, really, I understand why the market's really excited about TAC.
Oh yeah, I mean,
yeah, I don't know. I'm looking at. I see they got a good bit of debt, but given what they are,
I'm just trying to see what kind of battery energy storage systems they have, like how big they are.
Yes, because what we were talking about with some of the folks in the industry, one of the biggest problems is not only just power generation, storage is very important. And fun fact, like as we've been talking to folks, not begrudgingly, we don't marry ideas or theses, but Tesla is by far and away the leader there, or among the leaders there. And it's actually a very important part of the data center story. Now, I'm not making a justification for valuation. But that business line within Tesla is very successful.
This is super interesting, though, this theme. I'd have to look more into it, but I think this is super interesting. This company. I hadn't looked at or heard of them before.
Neither have I. So let me take a look. So it's like this is also trading at a pretty low forward multiple, about 8 times forward earnings.
Yeah, but like what I'm trying to understand is like how much of this is energy generation, how much of this is actual, because they have like a bunch of natural gas, wind, solar, hydro, coal facilities. Like it's there's a lot to kind of break apart with it.
Yeah, you would argue the energy storage business is really interesting, right?
Yeah.
Bless you.
Thank you. Yes.
I'm going to see what percent of their profit comes from, because it looks like majority of their sales revenue comes from the sale of energy from hydro, wind, and gas. But so, okay, energy transition segment is, I think, their energy storage. The EBITDA from that segment is 19 million off of an EBITDA figure of 349 million. So not very significant, to be honest, but could be growing quite a bit. We'd have to take a look at that growth and management's commentary on that.
Yeah, it could be something where that's not being priced into it, but also then you have to balance that with like everything else that they're doing. But it could be very interesting.
We'd have to then also talk to engineers to see is it true? Do they actually have an edge there? Or is it just like they're the lower quality player, but in this era, you can't get enough, so everyone gets business.
Yeah.
You know what I mean?
Yeah.
So even Applied Digital will get business.
If you would invested, you would have made a lot of money. So, funnily enough, I still made money being short, which I'm fine with. But
speaking of Applied Digital, it's up 11% today.
I think that whole sector is just it's kind of like,
holy crap.
Yeah.
That's crazy.
Well, and even within the sector, people are like, the valuation doesn't make sense if you compare it to like peers within it.
Oh man.
Yeah, I think the interesting names, I think we man, I'm just trying to double and triple check that there's nothing with, as I look at iRobot, that there's nothing I'm missing, but I don't see anything. This just feels like some kind of stupid pump. And to be clear for people, when I short things, the position sizing is so small. It's not something I'm worried about. I just like to see like, hey, what's happening? Is there anything I need to manage with it? So yeah, it doesn't look like anything big, but anyways, yeah, they're gonna, I don't see how these guys survive much longer. They're so, I don't know why.
I'm searching social media now to see what the talk is, but that would be so funny. Oh, it's a robot company. Pump it. No. Okay, just people talking about technicals.
So according to ChatGPT, what it's found is that a recent major event for iRobot is their going concern warning.
So, other words, there's nothing new today.
No, I don't think it sees anything. It looks like a technical. Yeah. Like I said, it's not something that's super. I mean, there's nothing going on. So, anyways, they are. I mean, maybe a pump like this helps them do it like an offering. But
this is going to be funny if it turns into another meme stock.
Yeah. And I'll get out. One of the things that's funny about a lot of short sellers is that they get very caught up in like having to be right, even when price action's going against them. So I'm fine with a 1-day pump, and I'll be like, okay, and just see what happens. But like, if this becomes like a meme stock, I'm like, okay, I'm not going to stand in the way of it. But let's see, what's their? Yeah, they have about they have a current ratio of like 0.5. So they have 2 times the debt, or 2 times the current liabilities that they have of current assets. I think they're just not paying their accounts payable, which is funny. Anyways, all that stuff doesn't matter. Because their accounts payable has gone up like 60 million from December through June.
Could it be? Remember, we've seen something like this before. A lot of buying ahead of some news.
No, not at this kind of volume. Someone who knows something, usually it's a single player, usually, and it's done this before. If you look at what it's done in the past, it has these kind of like pop up, go back down, pop up, go back down. It could have been just, hold on. Yeah, it's highly shorted. You got 8.2 million shares short on a 20. It's actually not that short on a 26.6 million float. Doesn't matter. Anyways, I'm not that concerned. I mean, I'll watch it, but like I said, the sizing on it makes me not really worried. And the only thing you could maybe sing is they're paying someone, because sometimes companies can do this, is pay someone to kind of try to push the stock price up so they can do an issuance, because that's like their only way out. But anyways, what was on the agenda? I kind of took it over with that. I don't mean to.
No, we covered everything on the agenda. We're in like the Q&A section, the bonus stuff, and we got a lot of questions about Progressive. I said I was going to talk about Progressive.
Oh, good, because I wanted to talk about Progressive.
So if you talk about Progressive, we're going to talk about it right now. It's melting over tough comps as far as I see. Yeah, so they reported earnings today, like they do every month. The earnings call is next month. But immediately in the press release, what stood out is, what the heck happened to profits? Right? You're like, oh my gosh, profits declined massively. Huge miss. Well, they had to record $950 million expense. Well, they didn't have to. They decided to record it all at once. Of what they estimate is that they're going to have to pay back to the customers in Florida because they made too much money. So part of the changes in regulation in Florida back in 2023 required, or to help the insurance industry, also put in limitations on how much profit they could make. All right, so it was a help and a take, right? A give and take. And Progressive in the state of Florida over that 3-year period surpassed the allowed profit. And so they estimate it will be about 950 some odd million. So they decided to expense that today or now. And that caused the miss. We saw adjusting for that, the combined ratio was still 86%. Top line growth 13%. And now, funny enough, and maybe this was obvious to us going into it, but maybe I misjudged the market seeing through that. But on a go forward basis, like this following year, it's going to be tough comparables for at least the next 12 months.
I don't know. How do you lose money on this stock over 3 years?
No, you say 3 years. I don't know, but if someone who's like, what's going to happen in the short term? Who knows?
But I mean, let's say they do 10% less net income than the last 12 months, right? As an example. Which I don't have entirely last 12 months, but I can pull it as a last probably quarterly report from an aggregator. Let me see. So if you did last 12 months, so as of 6/30, wouldn't include these. But last 12 months net income is that 10 billion? 10.5 billion? Spent just half year off ticker.
Mm-hmm.
You're doing 130 billion market cap with 6 billion of, it's actually probably a little higher than that, but 6 billion roughly of net cash. You're doing 124 billion enterprise value. So you're talking 12 times last 12 months earnings, even if you take a 10% haircut off that, which is like, their premiums are growing very well. 9388. I'm just gonna do it this way. So like a 7.5% earnings yield. So even if you took a 10% haircut on LTM earnings for the next year, and like, I don't know, this company is continuing to be a winner in the space. I mean, I'm just looking on the last time they had a decline in year over year profits, and I think that was in 2022. And that's probably because of like unmarked losses on their.
Yes.
And so I don't think they've ever actually had that happen. I don't know. It's one of those ones I look at and it's like, it feels like such a safe long. Like maybe it's not. When you look at risk reward, right? There's two. No one likes to look at the risk are. To me, the risk on this. I mean, some people are saying they're at peak margins. We'll see. What would their margins have been if you back out the 940?
86% combined ratio.
No, but
oh,
did they? Well, actually, question though, did they do a similar thing last September?
No.
So their combined ratio last September was 93.4%.
Yeah.
Oh, because storms. There's no storms this year.
No.
So, that could be a fair thing to try to model in.
But again, that's affecting only this month. That's not affecting them next month. So that 1 billion expense is one and done. It's done now.
Oh yeah. But I'm just trying to.
Hey, I'm happy. I'm getting money back. I'm gonna get rebated. Apparently, that's what they said. That's what they said in their press release. On December, they're going to pay back their Florida drivers.
I need to talk to someone about this. I know someone who works in the industry and probably has a good insight into how good they are. We have a few people that do.
Yeah. Look at that. Look at that beauty. I mean, I was starting off this stream today, talking about how a company like Progressive is just there's no appetite for it right now. But when shit hits the fan,
at some point, I mean, look, I hate looking at like historical things and being like, well, look at this. This is why it's good. But like, what's been the net income CAGR this company's grown at over the last 5 years?
The last 5 years in particular, it's been ridiculous.
Well, I mean, it's been ridiculous from 2022 onwards, but like, yeah, if you do last 10 years, maybe, but like, it's just kind of this up into the right company. I mean, I guess what analysts might be saying is, okay, they were like a very steady growing company if you go back to like through 2021, and then they kind of dip down for 2022 and then they rip back up. So maybe they like think it continues back to trend. And I don't know where that trend would be if you like took the 2021 trend of like steady earnings growth and just kind of modeled that out. Maybe they're above that and they're saying, no, they're going to come back. You know? I'll message you when I'm laughing at it. It's just something about position we have.
So, is it fair to adjust out the 99 credit if they indeed did over earn in the last period? So you don't adjust out the full amount, but it's all at once, right? It's not 950 million every month. That's what I'm mostly referring to, Skylarts. It's obviously far more spaced out. Realistically, divide that number by 3 years and also by 12. And then you'll get like the monthly adjustment on a go forward basis if you try to do like some rough math there.
Yeah, I just don't. I struggle with Progressive to look at this and say like, and to be clear, like, we don't really have much position in this. It's like something that we could look at and say like, man, like I don't. It's almost like this should be your hurdle rate for any investment, in my opinion.
That's where you're at with this? This is your hurdle rate?
Yeah. Model this out. Like, I'm going to model this out. Tell me how this doesn't return like a 15% CAGR over the next 3 to 5 years.
A catastrophe of epic proportion.
Yeah, I mean, like if a meteor hits America, I guess Progressive screwed, guys. Like all the other companies will be fine, I'm sure.
the mother of all storms.
But even then they have reinsurance.
Yeah, that is true. Yeah, there's a cap on that. They'll still get clapped, but yeah.
For Jorge, my biggest issue with PayPal is I think PayPal's fine. I just think there's better fintechs.
Yeah, Andrew's the bear. No, I'm kidding.
Not a bear. No, I think I'm constructive on PayPal, but I just think that there's better fintechs.
Of course. Some might say a little bear.
Well,
a little friendly bear.
That's not the one I was thinking of, but yeah.
Oh, the other one that is the superior buy now, pay never.
Yes.
Well,
I love that the narrative on BNPL is still like people don't understand it.
Well, didn't you know that the BNPL companies they don't want you to pay back the loans?
Yeah, I did know that. That's why I use BNPL and I don't pay back loans.
Yeah, didn't you know that Wall Street loves this business model and it makes tons of money, but at the same time is unprofitable? And I will hold both opinions at the same time and make a video about it.
No, my the favorite video I saw was the one girl who was like making a point that she didn't really have a point. She was just like, "Oh, consumers are using BNPL. Clearly, the consumer is screwed." And I was like, "That's your take?" And then she would, in the same argument, she made like the most bullish BNPL fundamental case you could, because she's talking about how like BNPL is degenerate and everything. And then she talks about how people are going to buy groceries with BNPL, but then when they go to buy it, the BNPL company denies them. And I think the one she used was Affirm. She's like, it denies them because it does its own algorithmic thing, doesn't it, not looking at your credit score, and deny them based on that. I was like, wait, so you're telling me that there's some credit company that like acts kind of like a credit card, but it actually denies people at point of purchase if it thinks that they can't like buy this item? Isn't that like super good? And I don't know. I could go on a BNPL rant right now, especially with like Affirm, and explain how cool things that they're going to be able to do like are, but people probably don't want to hear that. So
No, no one wants to hear that. No, no, please do, please do. We're in the Q&A section. We can talk
Okay,
about whatever.
sure. So one of the things I think is really cool about it too. So obviously they underwrite not every, but they can underwrite every single loan. But then let's also say you're a merchant, right? So like let's say you have Fabio's mountain bikes, right? You like to sell mountain bikes.
I do. I
and
love selling mountain bikes.
and let's say you have a model that you either want to, it's either not selling and you want to put it on clearance or sell it, or it's just like something that you want to put on a promotional discount, right? If I have a credit card, how can you, Fabio, incentivize me, the credit card holder, to, okay, iRobot's falling back down, to come to your store and buy?
So I have to incentivize not through advertising.
Yes, not through advertising, through my credit card.
Oh, well, I have to talk to, it has to be done at like some crazy scale, because I have to talk to your bank and then do like that credit card rewards deal where they get those bonus offers.
But it's just all that is if I spend money at your store, I get a rebate, like a 10%. Yeah. Okay. If I'm using a BNPL though, I go on my Affirm portal, and it says Fabio's mountain bikes, and I go there and it says special offer for you. You can get a 12-month loan for this at no interest because Fabio's paying the points on that loan. And so Fabio now is able to for just that bike, by the way, not for everything, for just that bike that you want to sell, that you want to get rid of. So you can actually say, hey, we have a special offer on this bike through my Affirm platform. You see how much better that is for the merchant? And then the other thing that's cool is maybe I go there and I say, well, you know, I'm on Affirm and I say, or I'm on Klarna or any of these, and I say, well, I need $1,000 loan. You say, well, yeah, we can do the 12-month loan. We also can do a 6-month loan for you, or an 18-month, or you can pay it in 4. And I don't think anyone understands how these work, or how much better this is going to be for merchants, and as a result for like the customers that are using it, and just how flexible they can do. So, here's a good question. I have some investments that have gone well: Sterling infrastructure, Arista networks, etc. But I think some of the valuations are getting pretty high, but still bullish in the long run. Any tips on profit taking / when to sell? Fabio?
Well, follow up, are all of those long-term capital gains yet? Because I mean, consider the tax consequence of selling, like what haircut you're going to take. I don't know what tax bracket you're in, or if you're in like a crazy tax bracket or a more reasonable tax bracket, but you want to take that into consideration as well. But I think it just really comes down to, do you see a better opportunity elsewhere? The answer to that, by the way, can always be, I see cash as a better opportunity than the following stocks. But at that point, you're like,
I mean, it's kind of difficult because it's a risk management question, and a lot of these risk management questions come down to what is your risk, like what's the rest of your portfolio look like?
yeah,
Because if you're like, hey, look, I have Arista and Sterling, and the rest of my account is healthcare insurance companies, Progressive, and all this other stuff, kind of be like, well, okay, like that's kind of looks like your risk on bucket, or like that, if you say, I have Arista and Sterling, the rest of my account is high beta, I'm in quantum computing and all this, I'd be like, okay, like maybe you need to control your exposure. It's very, and like, is it a 5% position? Is it a 1% position? Is it a 50% position? So there's like a lot of like questions that you kind of need to flesh it out with. So generally, I'd say that if you think that the valuation's stretched, you don't want to be overweight a position where you think the valuation is stretched.
yeah, you can maintain some exposure, but
Yeah.
if it's half your portfolio, you have a problem.
Also, it depends on what kind of investor you are, because you said you're still bullish in the long run. If you're someone who's like very sleepy with your account, which is not a bad thing, and you just say, yeah, I just kind of like let it do its thing and I don't really pay attention, then you probably do nothing. I mean, it just depends too on your style.
Yep. Yeah, that is very true. Because from the sounds of it, I mean, for those names in particular, the one that we have had some opinions elaborated on, Arista, that Arista might be in the near term a little stretched. But and Sterling looks pretty expensive for what it looks like historically. But where's the slowdown? And they just bought another business to grow capacity. So,
I mean, yeah. I think the only thing with Sterling that would concern me is like it does have to me it feels like it has had the
re-rate.
Yeah, it's been priced in. And if anything happens and that re-rates back to normal ENC, like well, it would have to go back to normal ENC margins, but if it goes back to normal ENC valuations, yeah, you have probably 60 to 70% downside at least. But it would also have to go back to normal ENC margins, which it's above by a lot right now.
Yeah. We have TSM report here soon, by the way. I think in a week or so. Look at this is so weird.
What?
So this TSM, it's so volatile recently. Actually, TSM's always been volatile. What am I saying? I'm ignore that. It's always been volatile.
Oh, you know who else reported this morning? Hold on. Dude.
Who? What?
It's not a company that we're in, but
oh, they report tomorrow?
No, they reported this morning.
Oh no, I don't want to look.
No. It's the actual report was very, very, very good.
The investor day is tomorrow?
Not sure.
No, it's on. Yeah, it's today. It's today.
Come on. Let me see something really quick because they usually have this. Oh, that trend that I've told you about that's going up, it continued going up. By here, I'll ping it to you.
So same store sales is still improving. Yeah, 3.8% looks like. Oh, wow.
I don't know if we can talk about it or not, but I just didn't want to. I don't know what we can and can't do now. So. Oh, Synchrony Financial reported today too.
We should take a look at them for consumer commentary.
And I know Prologis did and ASML. Did you look at ASML earnings?
No. What happened on their earnings?
No idea. I haven't looked.
It's up 3.4%.
So good, probably.
Yeah, if it's up, it's good.
I mean,
so they beat estimates on orders, and then still expecting China slowdown in demand.
To your question, TSM reports tomorrow.
I saw another calendar saying next week, but I thought I saw other calendars say tomorrow reports.
Let me go to their IR. Let's go to the source of truth. I'm an accountant, man. You always got to. What's the source of truth? That's always the question.
I see October 16, Thursday, October 16 on my data aggregator.
Okay, let me see.
So SYF discussed how consumer still remains resilient. Purchase volume was up 2%. Spend increased 5%. Higher spend per account. Frequency across credit grades and generations grew 3.4%. Average transaction volumes also improved. And value purchase volume was up also 3%. Co-branded cards, 8% growth. Synchrony sees strong consumer continuing.
Who called that? Who said the consumer is fine? I mean, I'm sorry. Because of first brands, everyone's dead. The markets are dead. The ABS transactions are gone. Well, it's like, it was funny because I've been very constructive going into this and saying like, because people are worried about like what's Trump doing, what's China doing, all this stuff. And I was like, well, Jamie Dimon just said the consumer's healthy. But then it was really funny because I saw a bunch of like bearish articles that were pulling out of context quotes from the earnings call. But I listened to the full earnings call. So they're like, it was like Jamie Dimon sees cockroaches in the market in terms of like bad lenders. But if you listen to the actual call, someone asked him like, do you think there's more first brands or tricolors? And he was like, well, my general rule is like, if there's one cockroach, there's always more, but we don't know. Like, we haven't seen anything. But like the actual tone was very positive.
No, man, everything's going to die. You'll see. You'll see.
Wow. Yeah, sure. We still think the consumer is in pretty good shape. This is a direct quote. They've been very resilient. We're not seeing any signs of weakness. We're actually seeing improvement as we think about both spending trends, but also what we're seeing on credit has outpaced our expectations. That's Synchrony.
Yep.
Yeah. So seems like the consumer is deed. You know who else reported that might be interesting to look at is Prologis.
Oh, PLD?
Yeah.
Yeah, I would love to hear what they have to say about manufacturing.
Oh, the stock chart says that whatever they said was good, but I don't know. You have to look at it.
Let me see as well. I'll take a look at what they said. Oh, wait, well, look at that. So they see stabilization and growth now after a historic warehouse vacancy period.
Okay. Pause. You know what I'm going to ask next?
Mm-hmm.
Trucking. What? Because that's going to lead to positive trucking trends, right?
Yes, which should be near the bottom. Closer to the bottom, let's just say. Muted response so far from the truckers. Obviously, people aren't.
Well, I'm asking less about the stock and more about like what would happen.
So vacancies in warehouse real estate was at an 11-year high. But it looks like it's peaked. And then a lot of comments on companies rethinking supply chain strategies, more in manufacturing and storage operations back to North America. Observed customers are increasing inventory levels in anticipation of potential supply disruptions, driving demand for warehouse space. Supply chains, they expect supply chains to start being built closer to end markets, increasing requirements for logistics and real estate demand in North America, particular United States and Mexico. Management believes the trend towards reshoring, regionalization will remain a structural tailwind for the sector for the coming years. There we go. I mean, that's just one company though, but.
So, yeah, that's been kind of my. I think we've talked about this, but basically, we took like 5 steps back, and we said, if you look at the real economy has been effectively in a recession since the end of 21. Look at trucking. Look at all these things. We've been in kind of a rolling recession since 21. You can only be in a recession for so long. Eventually, you stop receding. I mean, worst case scenario, yeah, maybe that ends at 0. Like who knows where the recession ends up, but eventually you stop having a recession and you start to have stabilization and then acceleration. And 5 years almost is a very long time to be in a recession. It's a very long time in this world. So, it's one of those things where you look at it and say, okay, well, what's going on and what's the actual trend. So that's kind of how I look at that, and how we're thinking about it. So, and then I don't know. I'm very constructive on the market as a whole right now. I think people point to like kind of abnormalities as a reason to be bearish. You can look at like quantum computing in these bubbles. But if you look at the actual market, it's very good. It's very healthy. People are saying they keep on talking about how like the S&P has just been like on a straight line up since 22. My argument would be from 21 to 20 to like, to the bottom in 22, you probably had almost a 40% drop if you inflation adjust that in rate terms. And I argue, by the way, I know that we technically didn't have a recession. That was a recession. We changed the meaning of recession so that we didn't have a recession. We didn't change it technically, but like what everyone's always said, it's like, oh, two quarters of negative real GDP growth. Well, we had that. But then the other thing is like they have to officially come out and label it a recession, and they never did. So, so if you look at that, I mean, that's a pretty significant drawdown. So to me, it feels like people are just overreacting to, recency bias, where post-Liberation Day, the SPY and the Qs have just been on a rampage. So it's just, I don't know. I think you and I are pretty aligned in that.
Yeah, eventually these guys are going to bottom out, and they might be doing that now. They've just been getting hammered year in, year out, and like the compound bros were, all over some of these names at the highs too.
Oh yeah. And that's the thing with compound bros, is it's like they just go like, it's been going up, like it'll keep going up, and
winners keep winning.
Yeah,
the old statement. Yeah.
So yeah, but I don't know what was on the rest of your agenda.
No, we covered everything. We're literally in the Q&A section, so if people have questions, they can go ahead and ask away, and then we can answer them. But I talked about a few things like private equity, which Apollo's roaring back already.
I have a question for you.
Yeah.
Do you know what the 10-year is at right now?
4.6.
Oh.
4.9.
Oh.
5.2.
No, it's at 4.01.
4.01.
Yeah.
Oh, what are mortgage rates at?
I'm seeing I just Googled it, on a 30-year fix, like 6.3 to 6.4.
Okay.
This one's saying an FHA 30-year fixed is 5.75 to 7.3. Obviously, that's depending on FICO scores. But
what's the 3-year at right now?
I don't have the 3-year in front of me. I have the 2-year, 3.5.
2-year, 3.5. Okay.
That's what this says here. Yeah. Can I talk a little bit about Allison?
Yeah, of course.
Someone just asked. That's why I'm saying that. Um, the thesis on Allison has changed a little bit because they were kind of like a company that should be I thought would grow a decent bit, had a good position, and was a buyback story. And when I say a buyback story, I want to be clear. That doesn't mean like my entire thesis is around like them doing buybacks and that's where I get my return from. The thing is like there's fundamental growth there, plus it's a quality company that's gonna be growing. Then they did this massive acquisition. And now I have to you have to go back and kind of repencil things out. But to your point, if you think that the real economy comes back, it could be very interesting from here as they work through this. Now they had to take on a decent bit of debt and everything to buy this company. I think it's going to be top line accretive. Well, obviously will be, and then I think it'll have some margin compression, which then may start to kind of come back. So it's kind of like you have to now, and I have not done this. You have to like remodel and re-underwrite Allison with the new company and with their products. And where do you think those products are? And how do they fit with Allison? And how are they going to do in general? And I just honestly haven't had the time to actually go through that exercise. So the short answer is like I'm kind of just in the I don't know phase right now. And yeah, so I think the actual Allison transmission business, the core one that I invested in, is still going to do well, especially if the economy comes back. The one thing that they might have an issue with is with crude oil prices going down, you may have less drilling, which they've been kind of suffering from for a while anyways. So there's that. But I think it's been very much de-risked. I sold at a very good time, but it's been very de-risked at this point.
I haven't seen this price yet. It's at $83.
Yeah.
Interesting.
It's a whole different thing, right? Because that was a massive acquisition they did. It was almost like a merger more than an acquisition, right? And so now it's like, okay, what are we looking at now? If I just pull up on like Ticker, it says it's at a 10 times next 12 months earnings multiple, a 7.8 times EV EBITDA. But like, and I think what's just been happening is now everyone's like, okay, like what are we looking at now? Because the situation has changed a lot. And the thing is, sell side's now penciling out a lot of top line growth over the next couple of years. So it may be that the company that they bought is growing more, and then together they'll grow a lot.
Interesting.
Damn.
Okay.
I'm going with Quantum right now.
What's going on with Quantum?
I don't know. You'd expect it to be up a lot today. INQ's down 4%.
Well, some names have started to pull back some. I think throughout the day the market's gotten slightly weaker.
Yeah, Rigetti's down 6%.
The market started off stronger.
Yeah.
Today, but then started to give some of that back.
I know, but it's interesting.
It's interesting to watch like United Health have such a strong relative performance past couple days versus the rest of the healthcare.
Yeah, but also like if you look on a technical basis, a lot of these names, I think the other names were outperforming United Health after United Health had that like rip after 13 Fs. And United Health kind of consolidated. So to me, it feels like United Health is just like, this is going to sound weird on like a stock price basis. It's just like 3 to 4 weeks ahead of the other stocks. Like it kind of like if you look like it went up a lot and then kind of consolidated a little bit. and then is going back up. The other ones, they kind of waited, then they started going up, and now they're consolidating. And so it wouldn't surprise me for them to then do what Unit Health does.
We're getting, well, Prio says the following about Allison.
Yeah, but Allison's they're not the same quality as premium manufacturers. Like, what are you comparing them to? Like a Cummins, a Caterpillar, or like those are the guys they can compete with directly. And I would never put Allison at the same PE as those. So
we're also getting asked a question about Fiserv, symbol FI.
Well, I mean, I think PayPal's a bad buy and Fiserv's an amazing buy because those two things make complete sense, right? Because PayPal's just a buyback story. Anyways, not so veiled shot at someone, but Fiserv is in a weird spot. I think they could come back, and I have no position in Fiserv one way or another, but they're heavily indebted. I mean, it's maybe not as bad as it could be, and now they're committing to doing buybacks at 130% of free cash flow, and they just made another acquisition.
Yeah, they stated their target leverage rate was like 3 times EBITDA, and they're at like 2.9 as of the last report.
It could be above that. Well, we don't know how much they're acquiring Stonecastle for.
Was it that much? I don't think it was.
I don't know.
I saw a number thrown out. Yeah.
I've used Stonecastle before.
Oh, not disclosed.
Yeah. So we don't know.
I can't imagine it's a lot.
I don't know. I mean, but like anything incremental is just more leverage.
Yeah. So then I don't understand how they're going to continue at the same prior rate of purchases as before. I agree with you.
And here's the thing is, it's basically been like this group of underperforming assets being carried by Clover, is my understanding.
Mm-hmm.
And I think Clover's kind of losing to Toast right now. So your one asset, and Square. So your one asset that was like doing pretty good, it's now not doing. So it's like, are you just buying a conglomerate of like, it's not shit codes, but it's like companies that are going to underperform.
Mm-hmm.
Because I'm not making the argument it's like a shit code land, to be clear, but like it's just, to me, it's actually I feel very similarly about Fiserv as I do about Block. It's like I look at it and I say, oh, if I like the theme of it, feels like a trap, because you look at it and say, well, it looks cheap, and that's the only reason you're buying it. If you look at the underlying products, I mean, if I want exposure to restaurants, I'm buying Toast. What are the other things they do? Payments, like payment plumbing, right? They do that, right?
Yeah, like they're core. Mm-hmm.
You could do an Adyen. That's better. I think PayPal's a better play on that. It's one of those things when I look at it and I say,
Their cash cow business, like their banking core business, is like, this is something Garzi pointed out, right? If some of the newer players that are superior in every way, which are working hard towards figuring that out, because that's the moneymaker. If they can figure out how to get a regional, larger firms to transition over, and just to keep in mind, Fiserv in the core banking business, for banking core business, they focus more so on the smaller banks. Fidelity focuses more on the larger banks. So Fiserv is credit unions, small regional banks. If a competitor figures out, and we're talking about the newer ones, the ones that have until now been focused mainly on the neobank sector, if they can figure it out, then oh boy, they're cooked. Because all the comments I hear on this is the product's pretty bleh, but you can't switch off of it. It's such a pain in the ass. What'd you find? Uh-oh.
I wonder if that's why the market's pulling back a little bit.
Oh.
This is a whole nother discussion, but
we can have it. I don't care.
It's just long. It could be long because there's you'd have to explain the nuance with it. And
I could summarize it if you want. I don't know if you do.
I mean, I know you can go ahead and summarize it. But
all right. So shout out to, we'll bring up his tweet. So this is perhaps why the market decided to pull back some. That's what Andrew is suggesting. We'll finish our thoughts here on Fiserv because there's more I have to say on it. Don't worry. But a little detour on what this is referring to. So if you guys don't know, there's something going on with this country, down here, just as the meme says, and just another part of Mexico. Have you seen that? Mexico. my birth country. But no, in all seriousness, a lot of people don't understand the nuance of why the U.S. is even involving itself. But I was having this conversation with Andrew. Who I love on this? David Orr. When you showed me David Orr,
I love everything David Orr, but
David Orr, he's American, right? Born and raised. Bro is very well researched. Okay, well, guy is very well researched on an international political situation of this country, Venezuela. I was quite surprised because as we were talking, the majority of Americans have no idea what the hell has been going on in there for a long time. And it's strange on a world stage adversarially why the backyard of the United States was allowed to fall into such disrepair and aid its enemies as much as it has. With the Hezbollah, Iran, all of them have a pretty interesting presence in Venezuela, which again, proximity to the United States is not that far away. But long story short, you have a very resource-rich nation with a very adversarial government, and the United States geopolitically, we went over this during the whole tariff debacle, what the United States has been focusing on. And I think if you got to that conclusion earlier on, instead of having a mental freak out and being retarded, you would have been able to profit sooner than others. But in light of what's going to happen in Venezuela, long-term bullish on what that implies for both the region and the United States securing something. So David Orr's view on this was actually quite a sigh of relief, I think, because I saw too many people who frankly never heard of the country maybe to begin with, or have a very surface level opinion on it. And that to back it up. But yeah, a lot of people, I said I was going to just give super brief summary, don't know the historical, let's say, nuances of the adversaries' involvement in Venezuela. And so geopolitically, it makes a lot of sense to me what way the United States would go after it.
Mm-hmm.
People are turning it more into a domestic political issue, and I think they're blah, 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 whatever.
But my base case has been, if something happens there, you'll have a small pullback, just geopolitical tensions, a pullback. And then people realize it was kind of like Iran, where like, except this one will be a little bit more because it's closer. It's all it, but yeah. Someone said, do you really think that Venezuela is a narco state?
Yeah. I mean, I was saying that before it became political to say that. I don't know why it's political suddenly to say that it is one. But yeah, it's been one for quite some time. So it goes hand in hand. Because, some people are like, I guess, mentally handicapped in the sense that if a certain person says something, they have to say the opposite instead of just taking everything at nuance and just saying like, oh, I disagree with this person on the following issues, but I'm not, just only against whatever the person says. So that way I'm against even the true things they say as well as the false things.
Right. So really, I thought Venezuela was tough on drugs. I can't tell if he's joking.
Bobo's trolling me.
Okay. But yeah,
Bobo's trolling me.
He's got to be.
Yeah, Venezuela for a long time has been tough on anyone who wanted to be a law-abiding citizen and didn't agree with the state. So, yeah, if you're enchufado, as they say, yeah, you've had a great time. Enchufado stands for plugged in. And I think the description or the statement is self-explanatory of what it means.
Right.
So overdosing on Tylenol is such a win. Wow, Tylenol and all that. You see, like, yeah, there's arguments that are just like, I don't know, whatever.
What is KB doing?
Kenvu?
Yeah, it's just kind of chilling.
Yeah, it's just chilling now. It had its little quick rally, but
yeah.
All right, but back on Fiserv real quick. So,
and I have to go here in like 2 minutes, but
yeah, look, I'm gonna close off anyway. I'm at 2 hours. I didn't expect to be the phone. Yeah, to wrap up with like Fiserv, the core business should do well for the time being because like there's this like gray rhino out there where you can kind of see these players are attempting to try to take share, but easier said than done. So for that period of time where nothing's happening, that business is still going to print money, and I say that literally, print money. Then the Clover business, the growth engine, should still do well. That drives their merchant acquisition business, which they're still the third player in terms of size, because the number one is going to be Global Payments after the Fidelity. And then the second player will be JP Morgan, then followed by Fiserv as the third player. That business also is literally a cash cow, a money printer business, immune to inflation. It's inferior to that of Visa, but in terms of where it sits on in the risk curve for transactions, but still pretty good, right? And you're basically taking a small fee of all the money that moves through. And again, still very respectable size at the third largest player. So all that, if nothing ever happens, it's trading at a relatively cheap valuation on a PE basis. However, I would argue maybe we should also consider the multiple of earnings on an enterprise value, because on an enterprise value, it's actually at $100 billion enterprise value. So we are respecting the debt that's there. We are respecting the fact that, hey, management said 3x EBITDA. We're at 2.9 times EBITDA. So either they pay down some debt or they have to grow a lot. I think sell side has them growing at strong mid-teens growth, which if they hit that and they continue to hit that, they'll grow out of this debt. Right. So they'll
Right.
go back to their target leverage rate.
I mean, they're on an EV to EBITDA basis, they're like way below historical norms.
Yes, I think they're at 10 times.
On sell side
Somewhere
numbers, it says nine times, but yeah, which is like 50% below their average.
And
But
I will say
growth
we are seeing what was that? Growth is what?
Growth hasn't been as good. I mean,
oh, okay. I will say there has been a noticeable uptick in volume, interest volume for them. As in someone out there's a lot of call buying.
yeah, there could be a reversal for sure.
Yeah. So I'm more betting on, and I said this to you and Garzi, and I think we're all in agreement here, is I'm more betting on there could be a near-term uptick. We could see pretty sharp, kind of bounce rally here on Fiserv. And I've been thinking about, doing something to try to profit from it, but yeah. All right. So in summary, Progressive, definitely a shitco, right? And
Yes, I'm short.
You're short Progressive, making lots of money. iRobot, probably a really good company. It's up a lot today. And then Apollo is a dead company too, because private credit is a bubble 2.0. And FICO is responsible for all of our housing prices being too expensive. That's also true. I'm trying to think of what else. And Venezuela is a very peaceful, U.S. friendly country.
Yes.
Can't gaslight it. Yeah. All right. With that being said, everyone, if there's no more questions, I'll head off here. Andrew, if you can head off whenever you would need to. I'm going to sit here for right now. Seconds. All right. Thank you for coming on, Andrew. FICO completely rug pulled the pump. It wasn't FICO. It was Equifax saying, okay, if I die, you're going to die too. Not literally, but in some sense, it feels like that. Answer me. What? Sorry. There's comments and I don't see them all. Are you still loading up on Meritage Homes? Okay, so that's a throwback to, I think, I don't know how long ago Meritage Homes was mentioned. And I believe the only relation was that we knew someone who worked at Meritage Homes, who doesn't work there anymore. But home builders, I'll answer the question seriously. I know you're joking with your question, but other people might have like a similar question aligned to that. It's home builders. We are a bit cautious on them right now for a few reasons. So Pulte was indicating a aggression towards the home builders, and not too long ago we saw the president come out and sort of go after them, saying all these a big rant on them. But another thing about home builders that is more concerning about the setup here is where existing home sales sit in relation to the new home sales. So in effect, that's competition for them. So if new home sales start to existing home sales start to pick up strongly and the availability of supply starts to pick up, that could be a headwind for new home sales. So this environment that we've been in for the past several years has been really good for the home builders. Supply constraints, as far as the eye can see, due to lack of supply in the existing home sales volume, and that coincides with the thesis on FICO and Equifax and the like, and mortgage originators being that we're not seeing this massive uptick in mortgage lending. So Meritage Homes being probably not the S tier quality builder is probably also due to suffer in the same bucket. And if I had to pull up their their stock price just to see. I would assume it's done as, well as the others, which is not that good. I believe Lennar is at 122. Yeah, so I mean, all of them have done. Yeah. He has his bags loaded. Don't trust this spy for real. What were your 2 questions, Kicker Steak? Let me scroll up. Do you have any rule as to the amount? There were 2 questions. Another question. Oh, wait. So, do you have any rule as to what options, shares, total percentage ratio of your portfolio should be at? I think I have a soft rule of like initial capital down on options to be somewhere around 20% or lower. But that doesn't mean I won't allow the options position to grow beyond that. But it's typically, I attempt to do 20% or less in options, 80% or more in common stock. Another question, you have any rule as far as the amount of puts in your margin portfolio? No more than, and I think you're referring to short puts. I try to keep it, around 20 to 30%. 20 to 30% or less. So like the most aggressive 30, but 20 to 30 is usually my range. Are you still loading up on Vistry? Yes, Vistry, my heavy-handed pitch. How are they doing, Stabulo? Are they still saying they're going to be buying back tons of stock, and then they're just not? Yeah. So on the question on short puts, yeah, it's between 20 to 30 is where I like to keep it. And so, for example, on the other question, so part of that I have the longer dated, pretty far out the money progressive calls. And so today those are getting, I think, destroyed. Let me check on the price. So they're down like 40-ish%. But as far as an expression in terms of dollars, it's, a small fraction. But if that position, which could change pretty quickly at any point in the future, because it is far out the money. So it's in terms of underlying value, it's a lot. And like what it represents in terms of shares, right? Because if you're going far out the money, you're able to buy more shares. And so expressing that position, gives me that like leveraged exposure to something like a progressive. And so over the next couple of years or so, if progressive does end up recovering and then surpassing the expectations, then that position will do really well. But if it doesn't do really well, the whole point of expressing it in the way I do is that, it'll just be like a little tick in the portfolio. Stabulo, do you still hold Vistry? I never sold. All I can say is we don't like Greg. If you don't keep up with Stabulo and what he's been doing with his portfolio, I mean, his portfolio is changing constantly. But I think I know the composition right now. Yeah, Vistry is long gone for Stabulo. All right, let's take a look at, so the market itself. Oh shit, I might have to act because I did want to make some purchases on Poggers. Progressive, for those who don't know, that's a comedic way of saying it. And it's unfortunately trying to tick back up, but all right, let's see. Markets are still green. Still green. Let's take a look at positioning though. Oh, I can talk about another company I picked up. I might do a video on them, but I picked up Constellation Software. They had the largest sell-off in the company's history. Not this one. CSU. I'll just do Constellation. There it is. CSU.to. I forgot the TO. Damn it. All right. Anyways, so in the company's history, they've never had this much of a drawdown. In fact, actually, we'll bring out one of the sponsors of today's show. I only use stuff that I actually use, and the product is actually good. The link is in the description below. So I will attest to the quality of the product. And that is here. So we can see, take a look at the drawdown, and I'll put it on like a max. You can see that they've never, ever had in the history of the company a drawdown as drastic as that. So what happened, right? A few things all at once, right? We saw a drawdown because Mark Leonard retired for health reasons. But that followed a conversation around the impairments or the coming impairments of artificial intelligence. Wouldn't this be so fun when I'm see, now I understand what these people on YouTube do this full time. They can just like stay on here during work hours. This is so fun, right? now all of you people continue to have real jobs, and I just sit here and entertain you, right? And I entertain myself because this is fun to sit here and I can talk all day, frankly. But yeah, Constellation Software down 30% or so. AI concerns, fears, whatever you want to call it. And I viewed it as, okay, you do have a legitimate concern regarding artificial intelligence. Why? Because supposedly it's going to increase the rate at you people. What do you mean, you people, bro? You people. Hey, you know what I meant. All right. I will be the last man standing. Well, we'll talk about Vistry in a second because I think it's interesting to talk about. Whoa. See, I always say I'm going to get off, and then you guys start asking me like the interesting questions that keeps me on. I guess this is also true. Well, technically there's 184 people watching, but it's across the different platforms. But yes, wherever you guys are watching me, like, share, subscribe, retweet, heart it, whatever, just show me that you're enjoying the content, and then we'll get through. I have no idea how many people are watching only on YouTube, but yeah, these likes are too low. You guys are hating the content. Oh my gosh. Anyways, so the advent of AI is decreasing the cost to go to market with new software solutions, right? Supposedly, and there's truth to that. Now, how does that directly impact Constellation? The answer is it's an unknown, right? And that's what Constellation says themselves. I know it's like a very underwhelming answer. It's like, well, we don't know. And because it simultaneously should have positive effects for Constellation and its various business units in both servicing their current customers and keeping up to date with new solutions and updating said solutions. And it could also drive down costs of maintenance, right? Some would argue. Now, at the same time, the other argument that Constellation made was that customers themselves could look to, create their own solutions internally. Now, the pushback to that is, if you guys have worked with anyone, any of these companies that use VMS software, would they probably go through all this effort for something that's probably mission critical to their business and just to save what should be a relatively minute cost for the overall operation? Probably not. Very likely not worth the effort. But who knows, right? And that was like the gist of the call. It was kind of funny where, if I had to summarize it, Mark Leonard said, "Who knows," right? That it in one phrase. So market didn't really like that. Obviously, when you tell the market "who knows," you're going to get a negative reaction. But this is one stock that I picked up, and I'm up a decent bit, not like a crazy amount, but And I also with Seymour Duck, I think, well, Seymour Duck has a weird time schedule. I doubt he's in the chat right now. He's probably sleeping. But I've also overweighted Topicus, because with Constellation, you have the different business units that were spun out, Lumine and Topicus, and then more to follow. So in order to replicate the parts of Constellation I like, I went long Constellation and then long Topicus to a little bit overweight Topicus back to something where it used to be. No. In there, he verbally stated that UNH was uniquely positioned, and it's not me the only one hearing this. When we all listened to that call, and not together, mind you, different individuals all within CM, and then we all came together to talk about it. It's like, I definitely did not mishear it, because unless we all misheard it, but he did state he could have lowered all his price targets, because he's wrong on all of them. He's wrong at the top and he's wrong at the bottom. I just view him as noise, to be clear. I'm not viewing him as a contra. He's not that bad, but noise, to be clear. I saw that comment come in. I'm bipolar on what I hold, but I normally continue liking what I sold. I get you. It pisses people off though, Stabilo. So you got to watch out for that. Vistry does seem cheap as fuck. Yes. So on that note, like, everyone should know, this is true for all investments. It's a beauty contest, and at the end of the day, all that matters is your total return. But yeah, so you can remain constructively bullish on Vistry, and I get it. And I see George here. He still has Vistry. I'll be the last man standing, because they're going to buy back enough shares, waiting for the buybacks to actually begin. See, like, and that's the question, right? So the part that was concerning when you looked at the Vistry thesis is, like, it was a buyback plus growth story. The growth didn't show up because of shenanigans that occurred at the business, and then subsequently the buybacks didn't show up. So then you has to bring into question is, like, what are we doing here? Is the money real? Are you the management confident in the longer term story of the business? PSA when you said before Christmas. Yeah. So okay, let's see here. I'm getting a notification that Crocs got wrecked today. Today? Oh, no, it didn't. It's like kind of flat today. Last time they dumped us with a lump of coal on the 24th. Yeah. Trust me that the buybacks are coming this Christmas. Don't worry. Don't worry, Stabilo. It's going to happen this time. I guess on another conversation, and we'll sort of wrap this up unless there's more questions. Adobe. So I got to tell you, I've been pretty interested in Adobe. It's always just like a question of relative opportunity, like what's out there. But Adobe's one that is often misquoted as far as like how cheap it is. This is actually correct for the gap figure, but this is TTM, obviously. The forward gap figure is, and again, when you look at a lot of the data aggregators, what they'll show is normalized or adjusted EPS. And so the PE ratio there is adjusting for stock-based comp. Now, stock-based comp isn't ridiculous at Adobe, mind you. It's manageable, but the GAAP earnings is actually a little bit worse off than obviously the adjusted figures. So when we take a look at the forward figures for Adobe, we're looking at just under 20, and then on a TTM basis, you can see it there at 21 times. And what do we got here? Well, we have a business growing earnings at 10 to 12%, top line, high single digits. And then the question really becomes or centered around the disruption story. I've talked about Adobe in the past and expressed my sort of concerns or doubt about the business. This was before AI, just like on a valuation basis, I didn't really see it. Now, the valuation has come down a lot, and really on a go forward basis, what does it look like? I think this could surprise to the upside if the narrative ends up being incorrect on the AI disruption, which I lean towards rather than being pessimistic. Then, yeah, I see Adobe as doing well from here. So those are my updated thoughts on Adobe versus the prior videos I've made years ago, and Adobe. The growth engine being in the amateur business, that's really what's come under fire. I think that's more under threat by Canva, but the whole Figma argument was ridiculous. They have very little overlap in terms of sales. Would you buy Crocs at this price? We'll talk about Crocs. We'll talk about Crocs. See, but yeah, otherwise, Adobe's doing pretty strong buybacks, putting pretty much all free cash flow towards the said buybacks, and that's optimistic. But they did a lot of buybacks at higher prices. Obviously in a perfect world, I would have hoped management is more prudent with their share repurchases, because share repurchases, when done improperly, are very destructive to shareholders, and people they don't appreciate that. So. Yeah, Firefly, their model sucks. But how I view constructively what Adobe could be is, the UI by which you interact with said LLMs, right? And you could be using other LLMs inside of the Adobe platform. And it's really a plug and play, and you kind of just pay per use. But the UI is there such that you can modify and make those last minute adjustments before pushing out, a professional work edit. Because you wouldn't just go to Gemini and simply ask it to do all of it for you, because there's always going to be like a little mistake here and there, and it's not up to the standards set by the professional market. The amateur market, totally different story, and that's why I emphasize amateur market growth engine. That's what I think is legitimately come into question, what Canva, what everyone else can really go after. The professional side, I doubt that. I doubt that. And I think that's maybe where we're moving towards with Adobe. It's becoming more the UI, how you interact with said tools. And a lot of the professionals are used to interacting. It's like the same thing with Excel. So are there better things than Excel? Absolutely. There's better options out there than Excel. But Excel is so ingrained and so learned. People don't want to learn new hotkeys. It's tough to retrain people. So Excel continues to be the dominant by far. Yeah. Wait, is there a profit sharing for using something like Gemini on paid version of Adobe AI? So you get, from my understanding, is you get a certain amount of token usages, and then afterwards it's a pay per use. So they would be passing it on and maybe some marginal profit to it. But yeah. Would I buy Crocs at this price? So yeah, Crocs looks really cheap, but remember that old thing that thing keeps haunting them. The only complaint I ever had about Crocs was the Hey Dude acquisition, and that's haunted them so much, to the point where the management did something horrendously stupid. They started to blame shareholders for the Hey Dude acquisition, which is stupid, really stupid, because they said something along the lines of, well, our shareholders wanted diversification and we gave it to you. We bought Hey Dude, as if they felt some sort of crazy pressure to buy Hey Dude. And they destroyed the balance sheet. They did, pretty much anything that I would complain about. They did it with Hey Dude. They bought an inferior business. And you want to talk about fads? Hey Dude's probably the closest thing to a fad in their portfolio, because the whole question before was like, is the clog a fad? And it's been a fad for like 20 years now. But I'm joking. It's come in and out of popularity in terms of heightened popularity, but it's becoming pretty popular in China. But that's neither here nor there. Hey Dude specifically, like, it continues to struggle. And the question was always, if they could get Hey Dude working, then the business was incredibly cheap. But you can see how much a bad acquisition can drag you down. Empire building is dangerous. It can turn a great stock into a terrible stock. And the management team really fumbled there. And the fact when they started blaming the shareholders for it was not good. Is PE dead? Well, we talked about private equity already, Fuhat, and obviously not. I know you're saying that facetiously, but yeah, I don't even know what's Apollo doing today. Okay, Apollo's up 0.06. I see what you're saying. It's dead because it pulled back. Well, if you see what's happened, Fuhat, there's a bit of a concern. I assume, let me check out the offshore drillers. Okay, so offshore drillers are up today. Yeah, this is probably just like a move off of the concerns on what's going to happen in Venezuela right now. So that's my assumption about what the market did today. Started off green, news came out that we had bombers and headed over there. We all know what that means. And then I think, damn it, Progressive is not staying down. Oh fuck. Well, when the market digests these earnings and looks past it, the market is very efficient. That's why there's no opportunities ever. You can't make money on stocks. I've been eating fiber. Oh, I'm not talking about your stuff, Fuhat. All right. If there are any last minute questions, I will go ahead and answer them. Oh, wait, no, we had this one. Will overthrowing governments in South America be bullish for Meli? I say yes, eventually change my mind. No, I can't change your mind on that. So Mercado Libre would benefit from increased economic prosperity in the region. So I would strongly argue that the current administration in Venezuela is very detrimental to the economic prosperity of that country. And other similar governments are also of a similar vein. But Mercado Libre is a great way to play, just like the full economic engine of Latin America, improving from here on. And not just improving, because it's improving plus addressing the market that already exists, because there's a market for them to grow into. And then that market can also grow. So they could get a benefit from both, right? Because they're addressing a problem that no one was really addressing before. So they can grow into that full addressable market. And then said full addressable market can expand from there if you start to see, strong economic performance from all of these countries. So I can't really disagree with you there from the specific point on BZLA. So can't change your mind on that, Taco Cat. All right. With that being said, I'm going to head out here, and I'll be seeing you guys on the next one. I'll hopefully be seeing you guys a lot more now because I'll have a lot more time on my hands. And these are fun anyways. So more content for CM. All right. With that being said, I'm going to leave you with a very cheesy, robotic, or AI-driven, disclaimer. And if you guys want to see the full list of disclosures in the description below. But otherwise, I'll see you guys on the next.
Thank you for watching this video from Fraxinus Capital Management. Before we close, please review these key disclosures. This video is provided for informational and educational purposes only. Nothing discussed here by Fabio, Managing Partner, or by Fraxinus Capital Management should be considered personal investment advice, a specific recommendation to buy or sell, or a solicitation for any security or financial product. The opinions presented are Fabio's and may not reflect those of Fraxinus Capital Management, its employees, or affiliates. Investing involves significant risk, including loss of principal, and past performance does not guarantee future results. Fraxinus Capital Management, its representatives, and clients, including Fabio, may buy or sell securities mentioned, and these positions may change without notice. No content on this channel constitutes an investment, offer, or solicitation. Official Fraxinus Capital Management offerings are made only through confidential documentation to qualified investors. For details or inquiries about services, please contact Fraxinus Capital Management directly. All information, including third-party data, is for general illustration and may become outdated. Viewers are responsible for their own financial decisions and should consult with licensed advisors before investing. Please note, the YouTube channel Capital Mindset is a separate entity from Fraxinus Capital Management. Engaging with this channel does not create an advisory or fiduciary relationship. By viewing, you acknowledge and accept these disclosures. Fraxinus Capital Management and Fabio are not responsible for losses from use of this material. Thank you for supporting Capital Mindset. Please subscribe for more educational content.